I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. This is your host, Dylan Marma, and today we are joined by a guest that I am very excited about having on the show. He's someone that's already added a lot of value to our business as we've entered the mobile home park space, and someone that continues to lead in the space as a thought leader that's sharing a lot of what he knows and his tricks of the trade openly through his podcast, through his blogs, and other platforms. This is none other than Ferd Niemann, known as the MHP Lawyer. Ferd is an active owner, operator, analyst, and lawyer. He wears a lot of hats day to day, growing his law business alongside his operations and his MHP business, very active. I see very often posting about deals that they're working on and closing on. So I can't imagine how he's able to get it all at once. But Ferd practiced law at a top Kansas City firm focusing on economic development incentives, public finance, property tax assessments, redevelopment, land use, and zoning. He was also the associate editor for Missouri Land Use Law and Practice and Missouri Economic Development Law, the foremost treatises in the field. Prior to law school, UMKC, Ferd graduated from Rockhurst University with a bachelor's degree in finance and an MBA. Well, Ferd, welcome to the show.
Thanks, Dylan. Thanks for having me. Thanks for the good intro.
Tell us, how did you first become exposed to the MHP business?
I first got exposed to it. I was a commercial real estate analyst at Jackson County, and I used to look at a bunch of commercial projects, mostly tax incentive projects, so mixed use, multifamily, retail, hospitality, some industrial, but just larger, complicated projects. And I saw the yield that the developers were making, and I wasn't that impressed with it for the amount of complexity and the skills and the capital these guys had. And I was doing single family and duplex at the time, and I'm making a better yield than this. Obviously, I was playing with 10,000 instead of 10 million, so it's easier to double 10,000 fast. But it made me just think there's got to be a better mousetrap. It's something that has higher profitability, lower expense ratio. So I just started researching every alternative asset class, and I found self-storage and MHP. I decided to pursue MHP instead of self-storage, and proof is in the pudding, and it just kept working. So I just, let's go look for one. So I called my dad and said, we should do this. He was okay. So I had a full-time job. Dad had just left the bank, so he was kind of doing freelance stuff, flipping houses and stuff. I said, why don't we look near your hometown? So we looked at my hometown and started making offers on parks and got one tied up, and then started working on it.
Oh, that's really interesting. I didn't realize that. I saw that your dad is a partner with you on deals that you have, it sounds like. I didn't know if he had been in the business previously or...
No, my dad grew up in family grocery, pony farm business and then grocery business. Did that for a number of years, like 25 years. Then my grandpa sold out his share of the family grocery business, and dad got a job at a bank. And he was not a banker per se. He was in real estate services and kind of property management. And the bankers were kind of corrupt, and the bank got shut down by the FDIC. So dad lost his job despite not doing anything wrong. So all of a sudden, boom, mid-50s, new career, and said, okay, let's get into real estate and start doing more investment houses, flipping houses. He was a realtor on the side, and then we got into MHP. Really just, I found out about it through online research, and then we ordered the Frank and Dave home study course before I knew they had the boot camp at least.
What year was this?
2014. Okay. So I think the boot camp was in existence. I just didn't hear about it. We ordered a CD set, listened to all the CDs. Actually, we already had a park. Actually, we bought a park without having it on our own, and then later went to the boot camp, later to CDs. But so obviously, kind of sharpening our saw and honing our craft over the years. But been in about 7 years, part time for most of those, and then more full time in the last several years. But and then obviously full time. As you mentioned, I've got the law firm business, which is real estate in general, but really heavy MHP focus. We do some apartment syndications and things like that for folks, but for the most part, it's 90% plus mobile home park specific.
Did you start the law firm simultaneously with your investment company?
No, the law firm, I practiced law at a Kansas City real estate firm for about 3 years. Then I went in-house and did retail development, real estate development for about 2.5 years. And then I hadn't practiced law for those 2.5 years, except for my own projects, my own tax incentives and stuff. And then I didn't start practicing law again until 10 months ago.
Oh, really?
I had
Wow.
practiced for years. I saw the gap in the marketplace for this asset class, for my services, and I had some niche knowledge, and I was just like, the pricing is kind of through the roof right now, so I don't want to go buy $1 million park for $2 million and compete on price just to get another deal. So I said, well, I might as well hang up my shingle. So I launched my podcast October of 2020, and got two new lawyers full time. I've hired about 10 other staff people. We've got 80 clients nationwide, big funds, little guys, all in between. So the law firm business has done very well. Been very fortunate on that, but continued to do the operational investment side as well. Done our own syndication. So it's just, they're all kind of related. I mean, I've got lawyers that in-house on my projects. They don't bill it out, but they help. They do our zoning research with me, title objections, contracts, leases, all that kind of stuff. So it's pretty synergistic.
That's incredible. The issues that you run into during due diligence, lawyers having a good lawyer behind you is crucial in this space. And there's very few lawyers that are very knowledgeable with what we need to be paying attention to close these transactions. So I think that's really neat that you're able to see the opportunity there in this niche and use all of your experience on the investment side and combining that with the time that you've spent in the law firm. Listening to some of your shows, I really can appreciate how you have taken the investor mindset and putting that into a lot of your contracts, right? I believe you refer to it as leading with an iron fist in some ways, in some of your tenant agreements, right? You want to make sure that you're intimidating them enough to not be breaking the rules and to maintain, peace, for lack of better words, in the community, but also knowing what the actual repercussions are when it comes down to push comes to shove, and if it does end up in court, if that's fair to say.
Yeah, sure. I mean, I kind of think of myself as a businessman first, and lawyer second. It's like, what's the business position? And then, okay, look at it with a legal lens, from a risk mitigation, from a law abiding circumstance, from just a overall risk analysis standpoint. But regularly I'll add stuff to documents or template documents. Like, wait a second, I want the back rent pre-closing, because here's why. Because in business, I don't want the seller chasing my tenants to collect rent, or things like, just things like that. Or I know sometimes I had a bank drop the ball on me 10 days before closing. I had a loan commitment, and CEO of the bank vetoed it. I'd already had my 25,000 go hard. I've already closed, and he's like, "Oh, it's in Illinois. I don't like Illinois." It was just like, loan committee approved it 7-0. And then it put me over a couple $1 million threshold, this particular bank. So they had to go to regional committee, which was headquarters, voted for it 7-0. It's like, great. 10 days before loan committee, chairman CEO says, "I don't like Illinois," vetoes it. So I've learned that sometimes, in this example, I was not able to deliver under a purchase contract through no fault of my own. So I put a provision in there, the conditions precedent, that if the appraisal comes in unsatisfactory, or if the loan approval comes in unsatisfactory, I stick my earnest money back, or I get an automatic time extension. So, and now, if in that case, I actually had another bank kind of save the day, so I still got the deal bought. But now my contract protects me from that oops moment. That was not really my fault. And the same thing with a number of other stuff. So yeah, but by having gone through the pain as a business owner of that particular item, I now know to put that in my legal contract, where the regular lawyer probably hasn't gone through that pain. The regular business person probably doesn't know how to, word it or add that verbiage into the contract to protect you in the future. So that's kind of how I just look at things like that.
It seems like that's how contracts get refined over time, is through those painful experiences. We had something similar recently, and it seems like an obvious and a given to always put an extension in your contract, but we were, for whatever reason, moving forward, we didn't feel like we needed it. We had the bank lined up, and we ended up getting to a point where our survey, the surveyor that we had initially engaged went completely dark on us. So last minute, we're having to spend double the amount to get a survey, and it's taking us an extra 10 days to close the deal. And now we have sellers that are not happy about the situation, and they start pressing us, and now they have leverage, right? Because we didn't have the extension. So now they're trying to get more money out of us just to get the deal across the finish line. And it gets really ugly in those situations. So now, lesson learned there was always have an extension, no matter what it costs, if it costs it more earnest money, whatever it might be. So that way you maintain the leverage in those pressing situations.
No, that's a great point. I love paid extensions. We use them all the time. It's like, look, if I'm wasting your time, I'm going to pay you for it. But if I'm not wasting my time, we use them in the manner of, I can put a really short DD timeline, which makes my offer competitive. But then I'll know, okay, if the earnest money is $5,000 and I got a $5,000 extension, and it's a big extension of 45 days, well, then I just look at it as, here's my real extension period. I do the expenses, I do the third-party reports early on, and then I can extend and close. So we've closed now, I think, 6 deals in the last 7 months. So we've just been kind of lining them up. I don't want to close more than one a month because it's too much to work on. So we've got one we're closing in July. We've already got one loan. The one in August doesn't have all the approvals yet, but the one in August is already in the pipeline. We could probably close them both in August or both in July. But if you have the extensions and you're already past your feasibility and you've done your real due diligence, I already know I'm going to close both these deals. I've got them waiting on the survey on one, but I've already got the phase one. I've already got loan approval. I've done all my on-site stuff. So now it's just a matter of balancing the workload, balancing if I'm going to raise capital and the timeline for that. So the extensions are crucial for, putting together an annual plan as to, what are you going to close 2 deals a year or 4 or 12? And obviously there's a pipeline issue. You can't close an infinite amount, but there's also a operational bandwidth issue that, you can't just close them. I can't close 10 deals in one day.
No, that hits home big time for us in the last 6 months. That's what it's felt like. That's a lot of the times why we're having to get these extensions, because you're so focused on closing the one deal, getting that one over the line, getting the money in place. And then as soon as you have that one closed, you're running over and picking up your slack from the next deal. And so I think that makes a ton of sense to strategically put the extensions in there so that you can balance bandwidth, because that is a real thing in this space. To place a large amount of capital, a lot of the times these deals are smaller and you have to do a lot of deals every month is possible. But at that point, you're going to be running around like crazy. So it's important that you try to space these out and be very strategic. I've definitely experienced some moments of stress or overwhelm with having too many irons in the fire, too many deals going, and you have to take a step back and focus and oftentimes plan for something like having an extension or something to that effect to make sure you're giving each deal the proper attention that it needs. You mentioned shorter due diligence period to be competitive. That's very important. Very frequent in today's world. We're seeing a lot of hard money day one. You're seeing shorter due diligence periods. You have to find ways to show that you're serious. What are you doing for a short due diligence period? How long are you typically going to try to negotiate? What are you going to do during that time period? And most importantly, what kind of contingencies do you put in place if you have a short due diligence period?
Well, the timeline is going to be negotiable, obviously, but I mean, we typically have a DD period of 30 days. Maybe if we have to do less, 15 or 20 on a specific deal, we might, but typically 30 days. And then an extension, sometimes we'll go for 2 30-day extensions and pay $5 or $10 of hard money on those. And now if you're doing a bigger project, you need more than 10,000, maybe 50,000 hard, but as far as what we do during that period, try to do the free stuff first. We get bids on things like phase one and survey, but I don't want to order a survey the first day. We generally get the title commitment pretty quick, so we'll do a title review, which we do in-house. We get the exception documents. If we need to read the easements, we will. And sometimes you need a lawyer for that. If it's basic title, there's no real easements, or the easement just says top north, the gas line's the north 10 feet from the west to east boundary. That's pretty easy. You don't need a survey to read that. You don't need perhaps legal knowledge to read that, but sometimes you do. So we do the title review. We would test the market, run a test ad. We'll try to drive the park before I make the offer. But if I haven't, then I'll do it before my due diligence is up. And drive the community, and then check the infrastructure. We do the zoning, we call the city. We research the zoning code rather than just call the city and get a certificate of zoning. That's like normal business practice, but which baffles me because the city's gonna say, here's what you got. And you might not like it. Or I like to read the code and tell the city, here's what I like about your code. Here's what I don't. Here's my opinion of grandfathering. Here's where it applies and doesn't apply. I have drafted a zoning letter that's very one-sided and favorable to me for your review. And sometimes they rubber stamp it right then, even if they shouldn't. Sometimes they'll say, I won't sign it no matter what. most of the time there's something in the middle. They'll say, okay, I can go with this and this, but not this and this. So we try to get that figured out because it depends on the project. If it's a stable deal, stabilized with occupancy, high occupancy, it's not as important. But if it's an infill project, it's really important to me to know what the setbacks are, what the age and size and other restrictions are on the vacant lots. And you're not going to get that in the certificate of zoning. It's going to say this is zoned R4. Okay, great. So I try to get all that snuffed out as early as possible. Other stuff we just we divvy up the work on our team. I mean, like, I'm not going to order my signage right now. I'm not going to research the state lease. If it's a state where it's new to us, I'm not going to research the lease stuff right now. I'm not going to draft my correspondence right now. I'm not going to raise money.
Get all the free stuff before you order third parties, I'm sure, as well.
Yeah, and then we do a preliminary budget, and then we go visit the site and we modify the budget. We do a day one CapEx budget, and then we do a P&L with infill assumptions and with rent raise. We do market rent study, those kind of things. There's a lot of little stuff on DD. I don't know how many stuff on my checklist, 75 things or something. So, but a lot of them can happen kind of later down the pipeline. Some of them can happen right before closing, like drafting a bill of sale and assignment of leases for closing. That can happen after your DD period, frankly. Unless you got a seller that you're really worried about, being difficult on closing docs. But so anyway, we don't create the LLCs to the last minute. Don't open the bank accounts to the last minute. Depending if we're going to syndicate it, we'll evaluate the size of the deal and how hard we think it's going to be, and then we typically will typically put a loan request in during early in the due diligence period once the budget is done, but not like final done, because it was always never final done, so you get everything back.
Yeah.
But try to get loan approval going and as fast as possible, because the appraisal is generally the appraisal and the survey are the slowest two things. 4 to 6 weeks for each of them typically.
Yep. Especially, it feels like lately those have been taking longer than usual, getting all the third parties back. But I think that's great for everyone to hear that there's a lot of the due diligence stuff that doesn't cost you anything, that is going to identify the largest risks in the deal. And zoning is not something to take lightly in this business. Very, very frequent on stuff with infill or even stuff that's existing, that there's violations on the setbacks, and there are, is it a sunset clause?
Yeah,
well?
There's some sunset clauses, and some of those are not valid, frankly. There's a lot of city ordinances, city codes that are not valid. And sometimes you can convince. I'm dealing with right now, and it's clearly discriminatory. And I found some cases. Actually, one of the guys in the hall did, but found some cases. This is in Texas, a small town I never heard of in Texas. We're like, it looks like the purpose of your law is to not let people of color in and people of low socioeconomic status. Is that what the plan is? And they're like, no, that's not it. Like, okay, well, we're going to need you to revise that ordinance and let us do what we want to do. And they get outside counsel involved, and it's not done yet, but I assume we're going to win that one pretty easily.
Yeah. Okay.
But anyway, that's part of the fun, I guess, is convincing the city that their ordinances are flawed and come to admit it. So.
Yeah, that's huge. And that, for us non-lawyers, that's why it's important to have a good lawyer on our team to help verify the validity of some of the things that we're up against, and double check us on these sort of things. Just from a personal standpoint, it seems like you're juggling a lot. You have 6 acquisitions going on in a year. You have the law firm, which is still sort of in its early stages, and looks like you're actively hiring and growing. How do you manage it all? What are your best time management practices, and what are your best practices for putting the right people in place to be able to delegate and help you grow?
That's a good question. As far as time management, Gary Keller has a book, The One Thing, on daily time management. I've been doing that since 2008. I didn't know, but before his book, but originally the story from Lee Ivey and Charles Schwab. So you can Google that. A good story on how to do daily time management, which is different than just a to-do list. It's a prioritization list. I read this book by Robin Sharma called 5 a.m. Club, and started implementing those practices. Get up at 5 a.m. and spend the first hour of your day getting yourself ready, exercise, prayer, meditation, thinking, reading. And then during work, the first hour of the day, highest priority. I don't take phone calls on Mondays. Can't get on my calendar. I organize my team on Monday, internal meetings on Monday. I have a daily briefing with my key managers, different park, different regional managers, that kind of thing. My lawyers I meet with on Mondays, and then touch base daily. And then I have my whole team do daily planning. And then Tony Robbins has a great time of your life weekly planning. It's actually a lifetime annual planning. So it's a pretty robust program. But I do that every Sunday, plan my week, and we go through top goals and priorities. And I've trained all my team to do all that kind of stuff. So big focus on productivity and efficiency. Planning is crucial. As far as filling out the team, that's one of the hardest things in life, I think, is finding people that want to are yoked together, want to row together. Um, I look for, they say there's, the old saying, I think Peter Drucker says this, get the right people in the right seats in the bus. And then there's the easy ones, that are people that are great attitude, great skill. You hire them. You got people that are bad attitude, bad skill. You never hire them. The tough ones are the ones in the middle. Is people that it's hard to find people on the first side, right? There's lots of people on the second side, but on the people in the middle, the people that have a good attitude but aren't that skilled. And those are people that, depending on the role, you hire them, you train them, and you invest in them. Then you have people that are talented, but they kind of have a bad attitude. And sometimes those people are attracted to hire. I joke with Terrell Owens, football player, superstar wide receiver, but he's a cancer in the locker room. So at some point, you're like, he's not worth it, right? So trying to find people with the right attitude, hustle, grit, ambition, desire to learn, which is easier to do in some roles, the sales roles, for example, than secretary.
Yeah.
Lawyers are harder to get like that, actually, because it's typically a high paid, high base salary profession. So it's not customary to say, hey, let me give you a base salary of this and this much in commission bonus. It doesn't really work like that. So it's hard to find people that have the right drive. We all work really hard. 50 hours full time for our company, and lots of us work more than that. So we have give by lots of bonuses for performance. So that helps a lot, as well as people that are willing to work hard, work extra, and if it works out, make more than they would at a regular job. If it doesn't, they're going to not like being here because they're working too hard for the money they're getting.
I think that's really well said. I find it can be tough to find the level of initiative that you may want to see all the time. And I don't mean initiative in terms of just sheer work ethic, but more so the thinking outside the box, creating the solution to the problem, right? To find someone that is thinking like an entrepreneur, to go and build out your next platform, right? To help grow the law firm, so that you're focusing on the operations, or you're focusing on growing the investment firm at times, right? So it oftentimes is, to sort of act as a bumper against that. It's oftentimes important that we have the right SOPs in place to be able to help guide people, rather than expecting them to create that themselves. Do you do anything along those lines to track your SOPs? And do you have any KPIs that you run your investment business with that you found to be helpful?
Well, in general, we track things like collections. We track things like occupancy. That's important. We run P&Ls every month for every property. So review that, look for variances, look for things that are off track. Like I mentioned, on training or on planning, everybody sends a daily plan to the whole company, so I know what you're working on, and I can review it, and I can reorganize your list, or I can not. And we send weekly planning, which really is more for each individual. I don't really review the weekly planning for everybody anymore because it's just too much time, but I will on a case by case basis. So we do some of that, but in general, it's try to be self-motivated. I have regular briefings with staff. They brief me on this, and then there's 4 of us that are generally principals on general partner stuff around here at this point. So we have weekly meetings and reviews. And go through, and I have everybody write me a written report every week as well. Not the lawyers, I guess. The lawyers, I'm generally in the loop because I'm generating all the work, so I know what I'm assigning to them. But my managers, I don't know what they're doing every day. But I can watch scope of work, I can watch the punch list, I can watch the process of sales, things like that, by seeing the variances from weekly reports. And I generally read those at night, and then I come into typically a briefing every morning at 9:30 with somebody, and then I've already deleted out all the stuff we don't even talk about because I read it and I got 3 or 4 things. It gives me access to them and vice versa. So that's really been a good, it's time consuming for me, but it's really a good way for me to be pretty.
I'm sure it's helpful on both sides too. Sometimes it helps to have that level of accountability to debrief and reflect on your week and what went well, what could have gone better, what are my intentions for next week. Just like your Sunday planning, it kind of gets everyone else focusing on the right things in that experience. Shifting gears from operations into acquisitions and the market today, you got started in around 2014. That is viewed now in some ways as maybe the early to mid golden age of mobile home park investing, right? And we're in a very, very different market in today's world. How have you changed the way that you view the market since then, when you first started to where you are now, right? What's changed about what you look for in deals, and where do you believe the opportunity in today's market is?
Yeah, I mean, back in 14, I probably made a mistake because I didn't even know about syndication and I didn't have any money, or no money of real substance. So I was like, okay, let's do one deal at a time. So then we did one and did one the next year and did one the next year. And there's smaller deals, under $1 million purchase price for each of the first 3 or 4 projects. So lesson learned, obviously I should have bought more of them, should have syndicated 7, 8, 10 years ago and would have been, infinitely wealthy at this point, but it didn't work out like that. So here I am still working. The market today is obviously a lot more competitive, tons of new buyers, tons of professional buyers, REITs, private equity groups. I see a lot of people overpaying like crazy, in my opinion. And I get access to lots of contracts in my law practice. So I watch the market very closely. And in the different regions and geographic areas. So I see people paying prices they're not going to get out from. I think a second good buy, the golden age was probably 2016, 17. I think the second golden age is probably 2024, when a lot of the people buying today are going to lose their properties and going to give up on the business, and they're going to sell them for 75 cents on the dollar, which is probably what they're really worth, is 75 cents on the dollar. Now, there'll be a lot of people ready to scoop those up. So the proven operators, I think, are going to be in better shape 3 years from now. And I think there's a lot of guys, unfortunately, I have some clients, I'm like, these guys aren't going to make it. I can tell. I give them, some people hire me to just do their paperwork. Some of them hire me to pick holes in their deal. And the ones that just want to do the paperwork need me to pick holes in their deal. But they're like, we're not paying you to do that. So I think the marketplace is going to have a lot of, overall, I'm bullish on the asset class. I think it's the right asset class. I think it's the best asset class. I think it's going to continue to be strong. I think we're probably less than 5 years away from full consolidation. But I think before that, you're going to see a lot of new operators, including some bigger ones. I mean, I can think of a couple groups that, bought 30, 40 parks last year. And when their loans come due, they better get gobbled up as a portfolio quick, because I think they're going to implode. I know guys that got 30 parks and they got 2 employees. I'm just like, how?
Crazy.
Yeah, how? And I'll tell them, I'll say, like, they'll say, do my title work. And I'll say, okay, you got a survey? We don't do surveys. Okay. Put together a PPM for you. You guys, let me get a copy of your phase 1. We don't do phase 1. Like, okay. So you bought $50 million of stuff last year and you're not even doing basic due diligence? No. We're just trying to acquire as much as we can for when it consolidates. And it might work out, but it might not. So anyway, as far as where the market's going, I think cap rates continue to compress. I think overall this is a superior asset class to multifamily even. So I think cap rates will compress to the level of multifamily, at least in key areas, key geographic regions. I think financing is going to get better. I think there's a risk of rent control. There's a couple groups out there that are jacking the rent up unreasonable levels, and they're going to ruin it for everybody.
Yeah, completely.
So I'm a little worried about that, which just hurts the reputation of the industry, of course.
Well, the people that are doing that are the same people that are buying at the scary prices that you're referencing, right? Because they're forced, in order to have any breathing room on the deal and to see the light of day and cash flow, then they might have to bring rents to market overnight, which of course is going to, like you said, have consequences for all of us.
Sure.
So I think that's a very valid point. What are the six? I'm sure as listeners are interested, either active or passive investors, they want to know how to avoid those sort of red flags or how to identify when a deal is being, quote unquote overpaid for, right? So what would you say are the biggest red flags to watch out for?
Well, the easy one is people that capitalize home rent. I mean, you just do the math. I did it the other day. It was like, you got a $400 home rent spread, 400 times 12 months, 4,800. At a 10 cap, that's 48,000. If the home is a 1985 Dutch,
Yep.
it's not a $48,000 house. You can, okay, we'll apply an expense ratio. Okay, well, what expense ratio? The third, what do you at then? 32,000? You make 32,000 for 1985 Dutch. What's the market for that?
Mm-hmm.
$4,500. So that's one way people, you do that on 30 park-owned homes, you're upside down pretty quick. So that's one big one. Another one is guys that are trying to monkey with the lot rent on park-owned homes. I'm looking at a deal here in Kansas City, and the seller, it's been listed forever. For a year with national brokers, like, oh, it's whatever cap rate, 7.5 cap. I'm like, no, it's not. You just made up the market rent on your park-owned homes.
Yep.
And you're saying the rent's 450, but really it's 300, and I'm not gonna fall for that. So that's another way.
And to the listeners, usually you want to watch the cap rate on the lot rent side only, right? Just to explain that further, right? Usually we want to see what the income is from the income associated to the lot side and the expenses, but it can get messy because it's a bit subjective. Which expenses are actually associated to the park-owned homes and which income is actually associated to the park-owned homes. And naturally, as a seller of a property, you want to say that as much of the income is associated to the lot as possible and as little of the expenses are associated to the lot as possible, so that you can maximize the value of the lot side of the business. So these are all tricks that get played that you need to be watching out for.
Sure. And other tricks or other problems I would say is if people are buying deals cash, there's no bank involved to second crunch your numbers. Not that the banks frankly are that sophisticated, but the appraiser is generally quasi sophisticated. And if you're buying a deal for 4 million and the appraiser says it's 3 million, that's going to be a gut check, and maybe you should look a little closer. But if you're buying it cash because you raised a bunch of private equity, oh, it's only 4 million. Or seller finance deals, be like, oh, there's no appraisal. I see clients all the time. They're buying seller finance deals at stupid pricing. They're like, yeah, but it's seller finance. Like, yeah, but when you sell it, you have that basis still. There's not enough spread. So that's sometimes is a problem. Paying for vacant lots, to some degree in the market, you can infill lots, and there is upside there. But I've seen people pay for a vacant lot like it's occupied. So, I mean, I lost a bid on a deal, and I was the best. I thought I was the best buyer. It was 20 minutes from my house. I already had maintenance local. I already had management local. I knew the park. I spent all the time to sell her, and I don't know what it was worth. I think I said 2.5 million, and somebody came in and offered 3.3 million cash, and I had done the math. I was like, I'm working for free for like 2.5 years of vacant lots. And then if I fill those, my absorption, whatever my ratio was, 12 per year or something, I go, okay, 2.5 years from now, I'm break even. And now if I fill the other 20 lots, I can make profit. So this guy gave 70% of his upside to the seller on a deal that I said to the seller, it's not going to price. There's no way the guy's going to get the loan. And he's out of state and all this. And he goes, well, he's paying cash. So he did.
And you need some kind of return on the brain damage, right? You can't overlook. It's easy to looking at a spreadsheet to overlook the amount of time and effort an infill deal or something of the like can take. So you need to be compensated extra for that because you're going to have extra bandwidth getting poured into that deal versus a standard stabilized asset. So I think it's a really good.
Well, and also when the deal in my case, I was going to get a loan for 75% of the deal. It wouldn't have covered the debt service at that higher price point. So now you got to feed the beast out of your personal reserves, and that's not fun. And what happens if something goes wrong? Oh, this one had a treatment plant that the DNR was already sniffing around. They already fined the guy 25 grand. So it's like they might come in and make you do a $200,000 upgrade. Well, that wasn't in the budget. So if you're already not covering debt service, that's going to get, it was no picnic. I'm eager to watch this guy. Maybe he's going to be more successful than me, but I'm eager to watch this project. But it's on my list of projects that 3 years from now, I might go buy it for the same price I offered today.
The hit list.
Yeah, I got a list.
Ferd, where's the best place that listeners can connect with you online?
My website, themhplawyer.com or mobilehomelawyer.com. I've got my podcast on there. My investment website's thirdivproperties.com. You can find me on LinkedIn, less so on Facebook. But you can hit me up to one of those websites and get on my email list, or it'll send me a message and I can get back to you there.
All right, well, we covered a lot of great stuff on today's episode. I hope the listeners got a lot out of this. I know I did. Ferd, thanks for joining us on the show and providing all the value you did.
You got it, no problem.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.